what's driving FX markets, and we've seen quite a decent rise in the dollar recently. So I want to sort of bring in Richard on this a little later, because there's quite a lot going on, and some of these charts are really quite interesting. So the dollar has seen a big spike higher. We've seen US yields rise, we've seen US assets rise. So quite a lot of dollars going into the US market. So I think what's driving this is this resilience I've been talking about in the economy. This is head and shoulders above the other G10 economies by some distance. And the dollar index, as you can see here on the 4-hour chart, has climbed really quite steeply, especially since those non-farm payrolls data, which beat in the headline. We saw unemployment staying where it was expected to go higher, and we've had higher wages. So, the traders had to react to the reality that the Fed is not cutting rates in March. And that pricing has now been reduced to almost nothing. So as you can see here, the March swaps price is only about 4 basis points of cuts. May about 22, just 3 basis points under a full cut. And, we go on along the curve. So I do think it's quite interesting that maybe investors are starting to think maybe the Fed is correct. So this market move to get ahead of the Fed is beginning to get expensive, and they're gradually moving these back. Again, the Fed's dots, the median level is about 3 cuts for this year. The market is still pricing 5. So again, something is wrong here. So I'm very interested to see how this pans out, and I think this rate cut idea is gradually being walked back. Now, that is exactly what we're hearing from the Fed as well. So if we have a look at sterling, I mean, it's quite interesting that sterling has started to underperform because it was holding up very well because the Bank of England was deemed to be the last ones to cut, as you were. But we've seen some pretty big adjustments from the Bank of England, slashing its inflation outlook for 2024. And it's confirmed a recession is likely unless rate cuts happen. So why aren't they cutting rates? That's a very good question. The problem is wages are still a little bit high, but countering that, we've seen very, very weak retail sales. Even in the run up to Christmas, the consumer, that is 70 to 75% of the economy, couldn't even buy into the end of Christmas. They may have bought earlier in some of the Black Friday sales in November, but the recent data also suggests that next Friday's data may not be much better. This has helped bring sterling down to the sort of bottom of its range, if you like, and possibly even breaking them depending on which chart you're looking at. But we're down to sort of 3-week lows, and cable's starting to look a little bit more vulnerable. And I don't think the market's short. So, if we look forward on that, the shift from the BOE has seen traders start to short the pound or possibly get out of their longs because it's less concrete that they are going to be the last to hike. And again, they are data dependent. What I don't understand is that they've got a 3-way split. How we're supposed to dig the bones out of that, I don't know, because we've got one that's looking for a hike. Two that are looking for a hike, one that's looking for a cut, and 6 that don't know. So it seems to me they're fairly clueless. Now, the problem with that is when central banks aren't sure what's going on, they usually do nothing. The unemployment data, Tuesday the 13th of February, is a key event, I think, for UK markets. And obviously, the day after, we get UK inflation data in the form of CPI as well. Another one you must put in your diary. That is probably going to move markets as well. Both those points, key factors for the Bank of England. But Richard, if we could have a look at the plus 500 chart for the sterling to see what it shows for you, that would be a great insight. Thank you.
Yeah, no problem, Mo. Sterling is very, very interesting from a technical perspective at the moment because, as your 4-hourly chart showed, we've just broken down from this sort of very choppy sideways trading activity, which was really something of a decision-making process or a battle, if you like, between the bulls and bears to see which one came out on top in terms of sterling. And it looks as though it's the directional bears of sterling that are really sort of starting to win the upper hand, in that we've broken out of the recent sideways trading range to the downside. We've started to see the indicators turning negative as well, but The one thing that we did do was test 125.27, which is the 38% retracement of the October-December rally. Now, this is obviously a very important technical level that we need to focus on. And you could argue that we probably need to break below this point on a closing basis to really sort of reflect a more negative development for sterling, positive for the US dollar, and that can trigger a more extended sell-off down towards the midpoint, even the 62% retracement level. So this 125.27 seems to be quite an important support focus that we need to watch and see how it is defended. In terms of resistance, for me, it's now 126.73, which is the current level of the declining Bollinger mid-average, because the market can rally back to a declining mid-average and then fail and resume what is still a bearish trending condition. So, we can even see further upside developing. But the evidence is that this resistance from this sideways range, the mid-average, can continue to hold. And the thing that's really sort of still maintaining more negative themes for me is that the MACD is now broken back below its zero line for the first time since early November last year, which reflects a more negative trending condition. Together with the Bollinger Min average falling, the fact that we've got that, and that negates the cross higher in daily momentum, because momentum is quite a volatile indicator. But the fact that we're below zero on the MACD is a concern. And for me, that would skew risks towards an upside failure at or just under this mid average. And that can retest this important support. And if that starts to give way, then sterling may well start to encounter more significant selling pressure and really see further downside beginning to materialize once more.
Thank you, Richard. I think those levels, seem to have held where they should at the moment. But pushing on, let's have a look at the Aussie. We have seen some underperformance out of Australia recently. I think we have actually seen on the domestic side of things inflation fall quite quickly. Headline CPI cooled more than expected, as you can see on the chart here on the right. That has turned the RBA, the central bank, from possibly hiking to talking about potential cuts. They weren't that dovish at the last meeting, but I do think that weaker Chinese economic data is weighing on the Aussie as well. So we have seen a little bit more stimulus from China trying to push the stock market up, and we've actually seen a little bit of a bounce on the Aussie today, but not a massive one, to be honest. Off the lows is all you could say. So for me, the 4-hour chart here shows you the weakness. We saw that weakness come in with the general stronger dollar, but I think there's domestic issues as well why the Aussie could sort of break a little lower. I think we broke below the 65 level for a while. I think a close below there is negative, but I think the RBA meeting and press conference confirm a dovish shift from the Australian central bank to me, that I don't think they're going to hike again. They've left the door open to one, but again, this is another central bank that's become data dependent, and the pace of that fall in inflation is enough to worry them. I think that they're probably going to hold on for a bit before they make a final decision. But I do think if we see unemployment levels start to rise, wages not rising at all, but in ongoing fall in inflation, then I think it's very possible the RBA could actually cut at some point this year. But I do think it's going to be later than the ECB, possibly even the Fed. So I think they haven't raised rates as much. Their economy is not quite as weak as the EU. So I think for the Aussie at the moment, I think that China is a concern. I think the domestic economy is weakening quite quickly. So therefore, I'm struggling to see, unless we get a huge boost and real data that shows economic growth out of China, then I think the Aussie could struggle a little while. So, Richard, for me, it looks fundamentally that it could see further weakness. What are you seeing on the broader charts?
Yeah, I would tend to agree with that, Mo. And I think the Aussie in general is still looking vulnerable within the overall structure, pretty much across many crosses. But the US dollar in particular, we have seen some fairly important technical breaks of late, and the first one really came a break below this blue trend line that I've put on the chart here, which I would argue is it could be viewed as a neckline of a head and shoulders top, which is a negative reversal pattern. It's not particularly reversing a significant amount, which maybe question it, but the fact that we've broken these lows, I think, is an important development. It highlights developing weakness within the currency, and that we obviously continue to have a bearish trend from not only the MACD indicator, but also the declining Bollinger Mid average. So evidence is still pointing to further downside. You mentioned, Mo, the 65 level on Aussie versus the US dollar. That equated to the 62% retracement of the October-December move. So even though we've rallied, having closed below that point, the overall risk is that this is still a limited bounce within a bearish trending condition. And the fact that we have closed below 65 maintains and highlights technical weakness and deterioration within the overall structure and the potential for further downside to develop. So while we're below this mid average, which currently stands at 65, 63, the risk is that upside still appears limited. And if we were to look at the 4-hourly chart, we can see that this choppy sideways consolidation activity above that 65 level that we were talking about, and that neckline support point that we were highlighting on the daily chart, you can see that the recovery, as impressive as that may well appear, seems to be nothing more than just a pullback towards this old choppy sideways trading activity, which naturally then develops into a resistance level and the potential for a new failure and resumption of downside moves. So really, this band for me looks to be quite a difficult stumbling block, quite a strong area of supply. And really, while we're below the January 30th high at 66.24, it's really difficult to view upside within the Aussie as anything more than just a limited move before we start to see pressure build. So, I think the overall risk for the Aussie is still from a more negative stance. Certainly against the dollar, that seems to be the case, but elsewhere within other Aussie crosses as well, that would seem to be materializing. And I think even if the Aussie does stage a rally here, this area of resistance is probably going to be quite a difficult stumbling block. And the risk is that that could hold or at least slow any attempts to see a more extended recovery before the failure starts to build. So I think the Aussie is certainly quite an interesting one at present, definitely.